Per usual, living on this channel is for educational purposes only and is not intended as financial advice. Macro Monday. Let's take a look at some data and some charts. Got to talk about Bitcoin for a second. We have quickly approached all-time high once again. I think we're at 67 and change at the moment. There was a low time frame pattern that we completed. I didn't mention it in the video yesterday, but I talked about it elsewhere. Ascending triangle, again, very low time frame stuff that we're looking at now. And that is always a sign that you are getting closer to what I think is going to be the eventual parabolic blow-off move. Whether or not that'll cause a 10, 20, 30% decline, I don't know. I don't think so. But I just think price reaches this euphoric crescendo, right? We have Coinbase going down again today, by the way. And it feels like we're ready for something like we had in 2017. And definitely a sign of that is the consolidation period is getting shorter and shorter. Very clearly, we're on a path towards a parabolic blow-off top. Not that that's a bad thing, not that you can't watch it happen, not that there's anything to do. It's just, I like to think about what's possible here, right? We're getting more media attention, more retail attention. So it certainly makes sense that that's coming here. Shortly, we've also got meme coins just, off the hook, which is never usually a good thing. So I don't want to sound bearish because I'm not. I'm about as bullish as you can get, as humanly possible. But I'm thinking, like, how could this blow up in our face here? That's one possibility. So look, if I want to construct a bearish argument, I would say, well, if we lose momentum here for whatever reason, if legacy starts to blow up, if jobs data is bad or whatever, pick your narrative. Doesn't matter. Inflation. Okay, whatever. Doesn't matter. If that happens, then maybe we could find ourselves retracing back to the 40s. I don't think we get as low as the 30s. That doesn't make any sense to me at all. I think we would struggle to get to the 50s. What we may see here is like a move to 80, a blow off top to 80. So, we tap 80 for like 2 seconds and then just sort of crumble back to 70. That probably makes the most sense. But I know there were people asking me about this type of chart, like, okay, can this be a massive inverted head and shoulders? I mean, I don't think so. I don't think that's where we're headed. This could play out as a cup and handle, but the most likely outcome with the flows where they are is just more bullishness. I bet volume today was 2.2 billion. Volume does not translate into flows, but it is a very good sign for some pretty insane flows numbers again today. We'll have those by midnight tonight, EST. I think two of the most important charts to watch right now outside of crypto, just to study on what parabolic advances look like, what blow-off tops could look like, is NVDA and SMCI, because these candles today, to me, look like shooting stars. You're getting this breakaway gap up. Not exactly something you want to see at the end of a 3-month advance or whatever this is. So definitely a little cautious there as well. And this is the type of thing that we could see with Bitcoin, where we have this ultra low time frame. Look at these 4-hour candles, right? Just crazy buys because of the ETFs, most likely, amongst other things. But this eventually usually ends like it did when Coinbase went down last week. We get some crazy wicks, and you just got to be careful, right? Funding is still hot. Everything is still overbought. That isn't a secret. And people tend to lose money up here because they think they're a genius and they just add more leverage, more collateral. And then in a blink of an eye, they get liquidated. So, if you're up 5,000% on a meme coin on 50x leverage, maybe a good idea to take some off the table. Just saying, just a suggestion, just a suggestion. Both NVIDIA and SMCI, unquestionably bullish, but would you want to be buying up here? Probably not. This was even included in the S&P 500 today, I believe. One other quick crypto thing, the correlations between Bitcoin and ETH, Bitcoin and legacy. A few people had questions about. This is basically the ETH BTC chart, but what you'll notice in bear markets is ETH and Bitcoin tend to correlate pretty heavily. In bull market periods, that's when things break away from each other. So currently we're seeing Bitcoin break away from ETH in the correlation department because of Bitcoin's strength. Bitcoin is also breaking away from, this is the S&P, correlation. Post-COVID, this spiked up quite a bit. And then in 2022, on the way down, again, a bear market, right? Bear market COVID, by the way, that massive spike down. In those periods, we see high correlation. So it's very good news to see that correlation dissipate, because this is one of the strongest arguments for Bitcoin, is that we are an uncorrelated asset as part of a well-rounded portfolio. We are the bananas on your Wheaties of your portfolio. We are the hot sauce on your eggs in the morning, whatever you want to think of that as. So we don't want to be correlated to legacy, to tech. We want to remain uncorrelated. Last correlation chart for DXY, we're actually recoupling with DXY. Previously, we were very inverse to DXY. So if anything, as bearish as a bullish DXY would be for Bitcoin, it might not be as bad as we think it is based on this correlation. It's mattered less and less, and that may change if, God forbid, rates go up again. Okay, that may change. But in the moment, the rate ceiling is in, and that is the general sentiment across the board. Talking about institutional crypto flows, we had a massive week, the second biggest week ever. This is from James at CoinShares, 1.8 billion. And if you're listening or watching anybody, I'm not going to name names here, but if you're taking an analysis from people that are excluding or just failing to mention this very simple fact, then you really have to question what the hell are they doing, okay? Because this is why we are mooning. It is that simple. Money is coming in. People are buying, period, okay? So as long as this continues, we can keep going up, right? We can keep having these parabolic advanced days, boring weekends, because everybody buys during the week for the ETFs. I've got no issues with that whatsoever. Grayscale still unloading. Nobody really cares anymore. Doesn't really matter. Most of this is going into Bitcoin, a little bit into Ethereum, some coming out of Solana again. So all the more evidence that Solana is not the play at the moment. This is kind of the mini sentiment gauge, the Sol ETH pair, if you will. And hey, if you want to load up on short Bitcoin up here, love it. Keep loading up on short Bitcoin. I guess I don't hate it as a hedge, but very interesting to be shorting at all-time highs. That always works out for people, right? And most of this is coming into the United States thanks to the low-cost ETF vehicles. As far as news this week, a lot of jobs numbers, ADP, unemployment. The only thing that really matters is the unemployment rate, NFP. You could argue ADP is important. Jerome Powell's talking a bunch of Fed speak. Sure, whatever. We got a Fed meeting in March. Based on Truflation, inflation is okay. As in, still declining, still flat, still at a multi-month low. If we look at the Fed's own estimates for February and for March, they have CPI rising, they have core CPI falling, they have core PCE falling, and they have PCE rising. So these aren't exactly in alignment with each other. Core is not in alignment with the rest of it. Just another way to interpret the data. We'll see what matters. They're going to say, the Fed's going to say, look, we still have a ways to go. We're not at our 2% core PCE target. Okay, keep rates where they're at. I don't care, right? Do we care on crypto? Has anybody really cared about rates? Has anybody in legacy really cared about rates? Clearly it hasn't mattered. We thought it would matter. We thought we'd want lower rates. You've got the macro doomer saying, once they cut rates, it's over, right? Well, rates are just being held where they're at. So we're good for now. The question in the back of my mind is, will Truflation catch up? Or is Truflation still the correct gauge? And because of the lagging housing component, the government numbers just are what they are, right? They might be rising, but that's the number that's important. It's not Truflation, unfortunately. So just have to keep that in mind looking at this data. Like, yes, this might be reality, but reality is not necessarily what government policy is based off of. It's based off of the numbers that they're seeing in their own data. If we look at the PCE numbers that came in recently, depending on how you want to measure this, again, this is core, but some of the points are rising, some of the points are falling. 6 month, 3 month, the target, look, are we there yet? No. That's fair. Are we getting there? Yeah. Are we suddenly rip-roaring inflation again? I don't think so. I would much rather rates here with risk just crumbling than having to deal with inflation, personally. Okay, that's my choice. So let the Fed keep things where they're at. Clearly the top end of the echelon in the socioeconomic ladder, they're doing okay. As far as liquidity is concerned, reverse repo continues to just slowly creep lower. Again, this is short-term parked money that money market accounts had shifted into because there was not a short-term yield. Once there were treasuries to buy with a short-term yield, money came out of reverse repo. That has allowed the US government to essentially issue debt on the short end without much consequence because there has been a buyer. If the buyer runs out, what will happen to yields? The buyer being reverse repo. So we'll see how low this can go, and we'll see if that causes problems with treasury auctions or not. But all this stuff sort of coming to a head, right? BTFP's ending, reverse repo is getting ground down to zero, unemployment numbers might be picking up, inflation might be picking up. Just things to watch for that may disrupt the apple cart on the risk front as we're kind of coming off this parabolic move on Bitcoin. Something people are beginning to ask is whether or not this Bitcoin move is just momentum. Is it government approvals with ETFs? Is it related to stuff like this where we're just on this runaway freight train with debt payments that we just can never really dig ourselves out of? Possibly. I think it could be everything, right? I think people are finally waking up and thinking, I got to do something. You know, I need insurance, and this is the insurance. Bitcoin is the insurance. Money supply is also down quite a bit. So M2 and M4, M1, M3, these are all different measures of money supply. Again, in the liquidity conversation, how much debt are we issuing? How much debt is being bought? What are yields? This is all sort of semi-related. The global liquidity picture has taken an upswing despite US M2 falling. And typically when M2 has fallen like this, or M4, we see cracks in the ecosystem. Somehow New York Community Bank has lived to die another day, being down 12% on a Monday. I thought for sure that the FDIC would have to step in over the weekend, but New York Community Bank continuing to swirl down the drain. Here's M4. The argument here being the inflation-adjusted M4 has come down, and we're back to our pre-pandemic trend line. At least we're getting there. So to me, this argues that despite the declines in liquidity broadly, we should be seeing even more of an upswing in liquidity pretty soon, just because we won't be seeing the declines that we've been seeing as sharply. And that, again, helps risk. It helps Bitcoin. It helps crypto. Bitcoin is the liquidity sponge of the world. So any increase in liquidity is great news for Bitcoin. As far as meeting probabilities, pretty much a no-brainer at this point, unless this jobs number comes out ugly at the end of the week, that the Fed will not be cutting this meeting at the end of the month. Based on what I'm seeing locally, again, the economy in my little bubble is doing just fine. So there's certainly no urgency, but the problem here is not, hey, let's just keep the rates up forever. The problem is, what can the economy tolerate without crumbling? You'll notice the macro accounts, every once in a while, every other day or something, they'll drip out some crazy layoff headline or salary stat. And that's part of a tight economy, right? That's part of a tight, restrictive policy. We are going to continue to see that, and that will eventually tip us into recession if the Fed doesn't navigate that appropriately. But so far, so good. You can't say we're in a recession here based on what I'm seeing. Here's the yield curve. We've been tracking this since the beginning of the year here. The belly of the curve, the 1, 2, 3, 4, 5, 7-year yields have come up quite a bit. Even the short-term yields have come up a little bit. Yield curve remains inverted on the 10-2 basis. It actually turned down a little bit recently. And I'd have to go back and look at the data, but I don't know if we've ever curled down back below the monthly moving average. So this yield curve picture is very different than what we've ever seen. It's already the longest, and things may get super interesting when this actually uninverts, when the Fed brings rates down. But like I said last week, for now we party. Unemployment still 3.7%. We'll see what that is at the end of the week. Certain states have rising unemployment. You would argue that, the bigger states maybe are the canaries in the coal mine. This is California. the bellwether states, Texas, Florida, and the SOM rule is referring to basically a point of no return. So there are some cracks in the system. It's there, you can find it, right? Not going to deny it, but it hasn't seemed to matter quite yet. GDP has also turned down a little bit, not as bullish of a picture as it was last week or the week before, and now the estimates are in line with Wall Street here at around 2%. 2% still fine, but again, everything's sort of kind of aligning to something may happen here pretty soon. By something happening, I mean something might blow up and the Fed might have to step in. I mean, that's just how it's going to be, right? The Fed's not going to let things just go to zero. The government's not going to let things go to zero in an election year. So I don't think most people are that concerned. Speaking of recession and economic health, this was an interesting data point, kind of random from last year about the cardboard box recession, kind of hinting at the lack of shipping or shipments using cardboard boxes. And that appears to have recovered. And it's just kind of funny how we had all these little data points sort of aligning towards recession that haven't materialized, right? We also still have fairly high credit card delinquencies across the board, certainly in the South and the Deep South. And this was of Q2 2023. So it definitely isn't going to get any better. And the debt situation for some people is just going to be unmanageable over time. And that includes the United States. The United States debt is going to be unmanageable. But households are certainly seeing a massive crunch if they're holding on to any sort of credit card debt. And speaking of households, there was some great Redfin housing data that we'll just run through real quick. Median asking price still rising, right? So this tells me supply is not high enough and or inflation is taking over, right? It's not like these houses got better year over year. Clearly the mortgage rate is also playing a big role there. Here's listings. We're not really seeing listings pick up in a big way. No one really wants to list their house if they know no one wants to buy it because of the mortgage rates, right? So there's kind of no perfect solution for inflation and rates. And we're still dealing with the consequences of printing all that money in 2020, right? And here's the housing payments, and you're seeing year over year over year over year, and it's just getting farther and farther out of reach for most people, especially if you're dealing with credit card debt, student loan debt. It's just becoming an impossibility for many to ever buy a home. So we'll see what this looks like when rates come down. But as of now, housing appreciation adjusted for inflation is just out of control, right? So if you own your house outright with a mortgage, or without a mortgage rather, you're sitting pretty. But if you are one of these people without a house or with a mortgage or needing a mortgage, it's a bit of a different story. And that just exacerbates the haves and the have-nots even more. Switch gears to charts here. We've got some seasonality stuff from Ryan Dietrich. He looked at when January and February were positive on the S&P. What does the rest of the year look like? And it looks pretty good. So we've got some contra evidence against recessions coming and everything's going to decline. It's a bear market. This is another seasonality chart relative to election years. And it's just completely different than what we've seen historically. I think the bears would say, oh, this is the alligator jaws. This is going to snap back to the midpoint. Certainly possible. But right now it looks like we're running pretty well and pretty hot here. Similar to this idea with altcoins, if we look at S&P relative to the world, or we look at US stocks, global stocks relative to Bitcoin, it's important to have some relative perspective here. And the S&P since the 2010s has just absolutely crushed Europe. And once again, you've got many, many people saying, the US is overvalued, the US isn't the place to invest. I'm not going to disagree, right? Again, with the alligator jaws, but that just has proven to be incorrect for many, many years. So it's hard to see this trend over time and think, yeah, this time is different. Europe's going to catch up to the United States. I mean, I'm an American, so of course I'm a US maximalist, but you could argue the same with Bitcoin and gold, right? Is gold going to ever catch up to Bitcoin? I don't think so. Semiconductor ETF hitting its target beautifully here. Again, just another reason probably to take some off on the semis. I sold this position on Friday, rotated into a Bitcoin ETF. I sold my Amazon position Friday, rotated that into an ETF for Bitcoin. Just feels like it's time. Tesla. Let's go through the Mag 7. Man, Tesla does not look good. If this ends up being a diamond top, it is ugly, ugly, ugly days for Tesla. Now, the technicals measure this to 0, which isn't possible, but it certainly doesn't look bullish. The cloud does not like it. And, I haven't been bullish on high time frames Tesla in a very, very, very long time. So the technicals still align with that. Apple's still working its way through this head and shoulders. And I think what also is helping Bitcoin here is the Mag 7 largely kind of falling down a little bit, right? They're getting kicked off their peg a little bit. And that's helping people, I would argue, rotate into Bitcoin even more, right? Like it's time. Okay. Everybody's kind of seeing and sensing what's going on here. Apple has its own problems. Google has its own problems. I don't know what you do with this chart. Netflix, it's a 45-degree angle since mid 2022. It's bullish. Sure. There was a place to get in, but up here, I don't really know what you do with this. Google probably needs a cup and handle to figure out what it's going to do with its life here at all-time highs. This is the type of argument people would make for Bitcoin at this current price, is that we're going to pull back. Everyone sees X level. Possible, right? Anything's possible. But if the flows continue, I think we're good to go. For higher, Meta, I don't know what you do with this chart either. It's literally just been straight up week after week after week after. Look at this thing. It's incredible what Meta has done. I just would not want to be a buyer up here. The cloud likes low 300s. Amazon also close to its target. Plenty of room for all-time highs. And I think people are getting a little bit nervous with all of the Mag 7 sort of pushing all-time highs, or at least trying to, but kind of doing so on rising wedges and bear divs and just generally being overbought, right? Microsoft cup and handle, also very near its logical TA target. So all in all, the legacy side, I talked about the S&P and NASDAQ yesterday, just looks ready to take a breather. S&P up 16 of 18 weeks. It'd certainly be healthy for the bigger indices, the Mag 7, everything to just relax, pull back just a little bit. That's kind of impossible for humans to do, is just chill and not FOMO. And we see that with NVIDIA and SMCI and Bitcoin, right? Here's ETHE, which has exceeded the 618 or whatever this is fib from the bear market. At this point, I'm even thinking of taking off this trade because the discount has closed enough to the point where relative to Bitcoin, it just doesn't make sense anymore to hold on to this. It's kind of like, once you value your life in Bitcoin, you can't help but look at everything else relative to Bitcoin, right? Here's ETHE GBTC, and this has kind of gone nowhere. It's just been a wash since the beginning of 2023. So I don't think there's a compelling argument at the current point in time that this magically just outperforms Bitcoin or outperforms the Bitcoin ETFs. If there's an ETH approval on the ETFs, maybe, but we're not quite there yet. But clearly there is not a trend there at all. Coin absolutely cooking today. Still in the pitchfork, still above the cloud. Everything here makes sense to me based on technicals, based on retail volume, based on all these headlines that Coinbase is going down, based on Bitcoin doing so well. And as bullish as this is, it doesn't even look mega overbought just yet. It had a deep pullback and it's just retracing that now and reaching new multi-year highs. Coinbase relative to BTC, again, kind of a wash. You could argue there's a pretty big range here. Maybe this starts to exceed the range, but I don't think there's a massive argument to hold one over the other here just yet. I know a lot of Bitcoiners who are not a fan of Coinbase, so they would never hold Coinbase anyway. But the technicals, I guess you could argue we might see a coin breakout here pretty soon relative to Bitcoin. Maybe the ETH ETF approvals would be enough to push this over the edge. Just something to watch and to think about. MSTR, unlike Coinbase, has slingshotted to the top of its pitchfork, definitely approaching oversold territory based on the previous 2 years of trend. Some of this is short squeeze, some of this just Sailor double tripling down on BTC. It looks good. I would just be very careful up here with expecting much more in the near term. Just a wild chart. Here's MSTR versus BTC, which has broken out on the weekly cloud. Talk about a chart that has just sort of gotten drained. Probably not the best direct measure to look at, but it's a data point, right? And it certainly looks like MSTR is rounding the corner for whatever reason. I guess if you can't access the Bitcoin ETFs, you're in MSTR. And lastly, on the miners, instead of looking at them all individually, I'll just look at WGMI relative to BTC. WGMI is the miner ETF. Mara might look a little better than this. CleanSpark will probably look better than this, but on balance, again, the miners have not had a good time over the past couple days, over the past couple weeks. And it's kind of a bounce or die situation here for the miners relative to Bitcoin. I'm half expecting post-halving to see this ratio hit a new all-time low. So we'll see. But if you're trading any miner individually, it's definitely something to think about on a relative value basis. If you're trying to allocate and play the home game with the 15 or so miners that do exist. So broadly, we're doing fine. Bitcoin's doing fine. Rates are doing fine. Is inflation creeping up? I don't know. I don't see it in the data, even though the government data says it is. And we'll see what jobs numbers look like at the end of the week. So far so good. We just have to really dodge the parabola, intense breakdown. We really have to dodge that. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.